Welcome to Macro Monday on Investec Focus Radio SA, a podcast about what's driving global and local markets. I'm Chris Holdsworth, Chief Investment Strategist at Investec Wealth and Investment. Every Monday morning, I'll update you on key developments from the past week and what you need to know about the week ahead. If you'd prefer to watch a video with the graphs and charts I referred to in the podcast, just go to investec.com/Macro Monday. This week, we're going to have a look at a range of commodity moves associated with the conflict in Iran. We're also going to have a look at why markets globally haven't moved as much as one would think. And then finally, we're going to have a look at a potential inflation scenario in SA. We're going to start off with the conflict in Iran. We're going to talk about a range of data points which we think are pretty important for the global economy, and we'll update these data points regularly over the coming few weeks. From an economic perspective, the most important one is the number of tankers transiting through the Strait of Hormuz. According to Bloomberg data, the 7-day average is now sitting at 2. That's down from 200. So clearly there is still quite sizable risks to global energy prices, bearing in mind about 20 to 25% of global oil supply transits through the strait on a daily basis under normal scenario. So quite clearly is some risk. And until we start to see the number of tankers passing through getting close to 200 again, we are going to have this overhang and this concern around global energy prices. It is worth noting that while we are seeing traffic through the Strait of Hormuz drop off, we are starting to see an increase in traffic through Suez Canal. It's quite interesting. We did see a sizable drop-off in 2023 as ships were attacked in that region, and we've subsequently now seen a reasonably sized uptick, although bear in mind it is still sitting about a third of where it was pre-2023. So still some long way to go before we see a normalization through that channel. But we have nonetheless seen more ships passing through there, and that should ease some of the risks that we're going to see on global container prices. Just looking at energy prices at the time of recording, we're looking at Brent around about $100 per barrel. It's a sizable uptick. There are only a handful of occasions that oil's been $100 per barrel in the past decade. So that does mean that we are going to see an uptick in transit costs. We are going to see an uptick too in inflation. And we're going to see an uptick in a variety of different fuel prices. We're going to see it for diesel, for ships. We're actually seeing it for jet fuel already, which is up around about 50% over the past couple of weeks. And there's an issue in Europe. We did mention this last week. We will update on this. We've seen a huge surge in natural gas prices in Europe in particular, much more so than in the US. In the US, they've got a surplus. They're trying to export. In Europe, they import from the rest of the world. And given reduced Russian supply and now reduced supply from the Middle East, we've seen a sizable surge in gas prices in Europe. And we've seen this movie before. It does tend to lead to higher energy prices, which weighs on the economy too. But in addition to that, we've seen a pretty sizable increase in grain prices. Grain prices are up around about 15% month to date, suggesting that we're going to see an increase in food price inflation in the near term. Looking at commodity prices, and this is a subset of what we think are the key commodities to keep an eye on. You look at oil. Oil's up 70% year to date, up over 50% over the past month alone. Clearly, that's going to have a sizable impact on global inflation, and we'll touch on that shortly. We've also had a sizable increase in coal. If oil goes up and energy prices go up, coal is in some ways a substitute for that when it comes to electricity generation at least. And so we'll expect to see an increase in coal demand. So coal prices up 25%, wheat up 22% year to date, aluminium up 15%. You get a lot of aluminium transiting through the Strait of Hormuz as well. So broadly speaking, quite sizable increase in energy prices, food prices, and aluminium, which threatens manufacturing. In contrast, if you look at copper's about flat. And I think that tells us that the market is expecting all these shocks to be quite short-lived, and they won't yet affect the global economy, and they won't yet affect the global industrial demand. That seems to be a risky view. And should this conflict persist, and should the strait be throttled for more than a couple of weeks or so, we would expect that to be associated with concern around global industrial demand and with that copper prices. It's also worth having a look at what's happened to global equity markets. But before we get there, it's worth just delving a little bit into the inflation story. So far, we've had inflation prints for last month for 35 of the 50 largest economies across the globe. Median inflation is sitting at 2.3%. Not particularly threatening if you're looking at through the rearview mirror. And similarly, in the US, inflation last month was just 2.4%. But there is reason for concern. Month to date, gasoline prices in the US are up 17%. Already we've seen a sizable increase. And if we translate that into what it means for CPI inflation, if gasoline prices simply remain where they are in the US and going forward, let's say for whatever reason, the month to date average is in fact the average we're going to get for the full month, and thereafter we're going to land up at that price over the next few months, just as a scenario to get an estimate. Then what happens is that US inflation gets close to 3.5%. In fact, next month alone, it picks up by 30 bips, gets to 2.7%. That's clearly very far away from the Fed's 2% target. And as a result, I think we can put a line through any cuts from the Fed anytime soon. And in fact, we probably need to start attaching a sizable probability to the fact that the Fed might hike and might have to hike in an environment of weak growth too. It makes it very difficult for the Fed. If it is in fact the case that the Fed cuts, they would be doing so because of a recession. And so the outlook for growth here does seem quite tenuous at best. And the outlook for the possibility of the Fed coming to the rescue also seems somewhat in question. We would need monthly inflation to be 0% for US inflation to get to 2% by July. And I think we can attach a very low probability to that. So there's a sizable shift in the current environment, both with regards to the inflation outlook and the growth outlook. But it seems the market doesn't quite believe that just yet. It's quite remarkable. If you look, as you said before, what's happened to energy prices, and we've had this huge surge in oil prices. Since the bombing campaign started, global equities are down 5%, US equities are down just 3.5%. And if you look year to date, US equities are down just 3%, while year to date energy prices and oil in particular is up 70%. That seems a sizable disconnect. And for us, it gives us reason for caution. It seems that the market is pricing in a very short-term spike in oil prices and for oil to come back quickly. And if it does, you're going to get a not a very exciting return out of equities because that appears to be what's priced in. There's an asymmetry here. Should it persist for more than a couple of weeks and the market starts to believe we're going to see higher inflation coming through, and with that the risk of the Fed not providing support, in fact maybe even hiking, we would expect that to be associated with quite weak returns in equities. Now, our Global Investment Strategy Group met last week, and that's a committee populated by investment professionals in our UK, Switzerland, and SA offices. And we decided to remain risk off. Our risk score remains at -0.5 in a range of -3 to +3, indicating that we're keeping some dry powder. For the reasons mentioned above, and in addition to that, the US market is simply just not cheap at this point. You're looking at a forward PE of about 21 times at about a 20% premium to the long-term average. So a market that's looking quite stretched with all of this uncertainty, with the potential for a drawdown coming up. So we'd prefer to keep some dry powder. We are going to meet in a month's time or so to reconsider the view. And at that point, if we do think that the market looks more attractive, we'll shift back to neutral or maybe even overweight. But in the interim, we remain slightly concerned around the outlook for equity markets and willing to be defensively positioned. By the way, the US market doesn't appear too expensive when you account for the fact that return on equity in the US is very high. If you look across sectors in the US, the most expensive sectors have high ROE and the cheaper sectors have low ROE, and there's a very neat fit between the two. And that tells us that the key metric that we need to keep an eye on is forward forecasts for return on equity. In effect, forward forecasts for earnings. Those haven't moved yet because analysts haven't yet had time to fully account for what might be a temporary shock in energy price. But as that shock persists and analysts start to express concern around forward earnings, we would expect that to be reflected in markets. So all told, I think there is still some reason for concern around equity markets, and we're happy to remain underweight risk for the moment. And finally, switching to South Africa, we've been running a few scenarios in the background around what happens to SA inflation, what happens to the SA economy, should the oil prices spike. And one of the scenarios that we've been looking at is if by the end of June, we're looking at an oil price of $125 a barrel. So up from the current 100. And what does that mean for South African inflation? And by the way, the betting market is pricing in about a 50% chance that oil will be between $100 and $150 by the end of June. So there's a sizable probability of this occurring. It is worth running this sort of scenario. Well, if we plug that into our model, it suggests that we'll be looking at SA inflation of about 7% by September. Now, it is just a model. There'll be a band of uncertainty around that, and the SARB will have a different model. And inflation is difficult to forecast under the best of scenarios. And so we must understand that it doesn't mean inflation definitely will be 7%, but it does just give an indication of the sort of upside risk to SA inflation should oil prices spike further off current levels. And I think from our purposes, what that means is we can, just like with the Fed, we can rule out any cuts from the SARB anytime soon. And should this scenario pan out, there's a non-negligible chance that we'll be looking at hikes in SA2, which would delay the recovery in SA Inc. And we'll update on this accordingly over the coming few weeks. That's where we're going to end it for this week. That's all for this episode. Do tune in next week for more investment insights from me, Chris Holdsworth, and the Investec Wealth and Investment team. If you haven't yet added us to your podcast feed, you can subscribe to Investec Focus Radio SA wherever you listen. And please take a minute to rate our podcast so we can surface this content to the broader investment community. If you want to see the graphs that are referenced in the podcast, you can watch a video version of this recording at investec.com/Macro Monday.
The views expressed are those of the contributors at the time of publication and do not necessarily represent the views of Investec Wealth and Investment International and should not be taken as advice, guidance, or recommendation. Investec Wealth and Investment International, a member of the JSE Equity, Equity Derivatives, Currency Derivatives, Bond Derivatives, and Interest Rate Derivatives markets, an authorized financial services provider and a registered credit provider.